Finance is fighting many fires. Firms are consolidating, bringing their multi-billion-dollar books together. But does bigger mean better? Can they solve a growing retirement income gap as the great wealth transfer from baby boomers to younger generations takes hold? How is the newest firm on the block thinking about all of that?
You can't just put all responsibility for these decisions onto the public sector. We do have to take some personal accountability and responsibility for our retirement savings.
There's a gap for us there. Can we afford it? Well, what's the best time to plant a tree 20 years ago? What's the second best time?
Today.
Yeah.
A dynamic duo doing an interview together for the first time. Malcolm Jackson and Matt Winneray, the former CEO of Jarden Wealth and the former CEO of the Super Fund, are set to lead a fresh finance merger. Called FirstCape, it will oversee $44 billion in funds. It merges a management team from 4 firms: Jarden, JB Were, Harbour Asset Management, and BNZ Wealth and its KiwiSaver scheme. It's one of many mergers to create efficiency and provide better solutions to more investors. But this would be one of the biggest. So how will its leaders use that as leverage? Well, thank you both so much for offering me this interview. It's great to see you two together.
Yeah, it's great to be here.
So today is day 1 of FirstCape. How does it feel?
It's actually a mix of emotions today. One of fatigue. It's been quite a lot of work to even get to the start line, but a huge amount of anticipation about what we can achieve here. And I think this is a chance for us as a collected group of companies to make a difference.
MJ, we should probably get the disclosure out of the way first. I did used to work for you, so we'll let my audience know about that one. He is a tough man to work for, tough but fair. He has, if you don't mind me saying, MJ, one of the best BS readers that I've ever worked with. You ready for that, Matt?
Yeah, absolutely. We'll be looking to stamp that out, so it's good to have it.
How did this dynamic duo and partnership come to be? Who approached who?
So I got a call from Bill Trotter, who's the chair of Jarden, and I'd many years ago worked for First NZ Capital and investment banking. Knew Bill from that. I was there when we created the current iteration of First NZ Capital, now Jarden. So Bill called me. I was at the time trying to have a break and wasn't really that keen on stepping into anything, but he said, please come and have a chat with Malcolm and with the other people involved, and it really went from there. I really enjoyed the conversations with Malcolm, excited by the opportunity that this presents, both in terms of the broader system perspective as well as just the power that a business of this breadth and scale will provide now. So yeah, it came from not really looking for it, but it just, I know a number of the people involved, I rate them, it's intriguing, it's in my sort of space. So yeah, that's how it happened.
Yeah, I never picked you as the type to retire early, if I'm honest. MJ, Matt mentioned power, and this is a merging of 4 financial firms if you also include Harbour Asset Management. How is this going to work? Because it's not just a merging of firms, it's also a merging of people and systems. So who actually rules here?
Well, it's bringing together under a single banner of FirstCape. The brands will continue today as they did yesterday. On the asset management side, it's more straightforward. There's only one brand there, and that's Harbour, and Harbour's an asset manager, and it's now producing and manufacturing the product for the BNZ KiwiSaver product. So that's all quite straightforward on the asset management side. There should be a operating efficiency for the business there, because you are effectively insourcing the product manufacturing capability, which BNZ had previously outsourced. Harbour previously managed money for BNZ, so it's a pretty seamless transition to bring those into one. So that's pretty straightforward on that side. The other side of the business, which is unapologetically separate from the asset management side, is the wealth management side, and there's 2 very well respected brands in market there. In the case of JB Were, going back over 100 years, and in the case of Jarden, going back over 60 years. So both of them have their own history, their brand, their clients, their advisors who are very committed to those brands. The operational synergy there is more on the platform and the procurement behind the scenes around research, around custody, around the operating platforms, less so than at the front.
Efficiency gains, I'm assuming, correct me if I'm wrong, those are going to be savings that can then be passed on to customers, which are in this case investors.
It's either savings or better products.
Which is it going to be? Both?
Hopefully both. But it depends on what the product cost to manufacture is, but the advantage of having scale procurement advantages does mean we can deliver hopefully better outcomes for our clients. I think that's the part which got Matt and I together and quite excited was if you think about the New Zealand KiwiSaver market and where we sit from a pension deficit perspective and what we need to do in retirement savings, and the amount of fragmented subscale players in that KiwiSaver market is such that I'm not sure the best outcomes are being delivered, because unless you're at a certain scale point, you're not focused on client outcomes, you're focused on generating enough fee income to survive. And so it's not until you get to a certain scale where you are starting to be able to deliver better client outcomes.
The government pension burden and retirement income gap is real. It's something BlackRock's Larry Fink has recently raised the alarm on. According to our Retirement Commission, 40% of retirees survive solely on super, a universal payment of around $700 a week after tax for a couple aged over 65. About $200 less than a no-frills lifestyle costs in a major city today. Because of the baby boomer generation, it's estimated that by the 2060s, 60% of the population of OECD economies will be retired, meaning there'll be more people drawing down on their savings than contributing to them. This retirement income gap, or rather the growing government pension burden, we have more people retiring, a larger percentage of the population. Matt, you know all of this very well. They are going to live longer in a more expensive economy. Can we afford that as a country?
Well, we've got to start doing something about it. So I've spent the last 15 years at the Guardians working on what's thought of as the first pillar of retirement savings. So if you think about retirement savings in the broader sense, typically we talk of three pillars. So there's the universal pension that we all get when we turn 65, and that's where the super fund is looking to partially pre-fund that obligation. And that is, you're right, an increasing obligation as we have an ageing population. Fewer taxpayers, more recipients. The second pillar is compulsory workplace savings. Obviously we don't have that, so we've already got an issue in terms of holding our roof up in terms of the retirement savings. Third pillar is this voluntary retirement savings, and that's why I think the absence of the middle one plus the increased cost of the first one makes this third pillar so important, and that's where FirstCape is involved. And so I think there's just an opportunity in there to start to work on creating those better futures, creating an increase in the overall retirement savings pool. That means going to system settings as well as just providing great investment services to clients, but being involved in that conversation as well. As we look across the ditch, we look jealously at the level of retirement savings over there as a percentage of GDP. We think what could have been if we hadn't shut our one down in 1975. But there's a gap for us there. Can we afford it? Well, what's the best time to plant a tree 20 years ago? What's the second best time?
Today.
Yeah.
Matt, you mentioned settings there, and I do want to ask for both of your views on what we can fix on the KiwiSaver functions and policy settings of that retirement savings scheme. But if we could just size up the problem, MJ, how big is this retirement funding gap? And to what size do you think we need to get our private savings pool, that pillar that Matt spoke about, to solve it?
Well, if you compare us, as Matt did, and as much as we dislike being compared to our Australian counterparts over the Tasman, they have on average over 120,000 Australian dollars per person in their superannuation system, and we average closer to $30,000. So if you want to see the difference between where we are and where we should be, that's probably your best example. They are at a more mature state, and that's probably where we need to be. If you are at, it's fanciful to think that you're going to fund retirement on $30,000 in addition to your super. As Matt said, that pillar is struggling at best to deliver its outcome. To say that you're going to then stretch the next 20 years of your life in retirement out over $30,000, that's insufficient. If you move that to $120,000 and the income that $120,000 per person can generate, that starts to create pathways to having a more sustainable retirement.
It's not only inefficient, but I'm assuming those numbers are also not inflation adjusted, are they? That's an added complication to the mix.
Correct. And so that is also about people who are saving for retirement needing to be investing into products which are capable of staying ahead of inflation.
You said this quote in one of the first press releases that you put out together the other week, MJ. Quote, "There's a lot of work to be done to ensure we are a nation with the means to retire and live well. And FirstCape will not be shying away from driving this." Why are you making this FirstCape's problem to solve? Is it not a public sector issue?
I think it's an issue which we can all solve together. You can't just put all responsibility for these decisions onto the public sector. We do have to take some personal accountability and responsibility for our retirement savings. So, yes, there was a decision made a few years ago that state super would be the dominant source of retirement earnings. But as our needs have changed and as our requirements in retirement and our life expectancies have increased, we do need to take some personal responsibility for funding that gap. And that is where the role of the third pillar, which Matt refers to, comes into play. And that's why we're excited about being able to have a voice in market to help change those settings.
Matt, is this slightly personal for you? Given your time at the super fund, you spent years and a lot of your career building up that pile of wealth to $70 billion, $72.4 billion on the market when I checked its website yesterday. I'm assuming you don't want to see all of that eroded and drawn down upon quickly.
Yeah, well, look, that's part of the solution to this, and I loved working there, loved building it to that 72 billion, but it's always only ever going to be part of the solution. It's going to be partially pre-funding, and a great piece of work from Sir Michael Cullen. On the current estimates will pre-fund half of the increase from the time and when it was done. So he saw this problem coming, did something about it literally 20 years ago. So there we go, planted the tree 20 years ago. But it's only ever going to be part of it. So we've still got those other two, well, really one. If we look across the Tasman at where their settings are, theirs is a compulsory scheme. They're on their way to 12% in terms of the percentage contribution of the annual salary or annual wages. We are voluntary. We are at a minimum of 6%, and there are a lot of people who aren't contributing and who are members of KiwiSaver. So we're sort of vastly different settings there. They have some other settings around tax as well, which I think make a difference. But I think there's you can see part of the gap in terms of that. Now, you can't shift people from 6 to 12 straight away without causing an impact on their day to day, because this is saving. By definition, it's deferred consumption, so it means you're not consuming it today. But you can do that in a way, and Australians have done this in a steady way, where you can slowly increase that over time. You look to increase that at a level which is going to be lower than the growth in wage inflation, so that people don't see a degradation in dollar terms, or nominal terms, of what they're receiving in their pay packets, and over time you get yourself to that sort of level, and with that level plus the compounding returns, then suddenly you find yourself at north of 100% of GDP in terms of their super system. So we can look to other places to see how can you solve this, and need to adapt that to our context, but do it in a way which gets you there without causing some big disjunct.
But bottom line, we are going to have to make those hard choices, and I'm taking from what you're telling me that there are going to have to be some changes to the settings of the likes of KiwiSaver.
Well, I think there are. I think there do need to be some changes to those settings, I think there's a desire to have a look at those settings from the current government, which is great. We should have that conversation. We are really up for being part of that conversation and talking about how we can get there and helping to be part of that solution.
What about changing the retirement age? I mean, people in this country are working until they're about 67 anyway. I'm assuming that's not because they want to work longer, but because they financially have to.
Yeah, so changing the retirement age is really about dealing with the affordability of the first pillar. So what that does is it changes how much. So what are the conversations you have there? You have conversations about changing the retirement age. You have conversations around means testing, which is like the third rail. Nobody ever wants to touch it. But that's really about that first one. What the other bits go to? Do you have a second pillar, for example? and how do you bolster that third pillar, the individual retirement savings that people have, and they're all part of it because they all add together, the universal piece plus individual savings, combine to provide a certain level of retirement income, and really what you're trying to do is increase that over time and increase the percentage of replacement that presents over time.
Yeah, I don't think changing the settings on KiwiSaver is as tough a point as you're making. It's much tougher around dealing with changing retirement age on the first pillar. Even having a conversation about the second pillar seems to be off the table. And so if you look at the three different options, changing the KiwiSaver settings seems to be the easiest one by far. And I think we have done some really good things in the way this KiwiSaver system was set up in New Zealand, have taken some positive lessons away from Australia in terms of having it as a single KiwiSaver provider. It's all controlled through the IRD. The ability to switch is very easy. So we've done some things really, really well, and the system and the is all set up. It's just almost some stroke of the pen to make these changes. They're not that hard. The other ones you refer to are hard.
Historically, wealth has been created in this country by property, and there's a rather obsession with property and investing in it because it is the tax advantageous asset. But what if the Reserve Bank implements debt to income restrictions that would effectively shorten the leash on any returns to be made in property, residential property at least? How do you see that potentially redirecting wealth, and where to in this country?
You're right. I think New Zealand does have almost an unhealthy obsession with property ownership, and it has historically actually been the third pillar we've talked about in the retirement savings world. It has been their KiwiSaver. It has been their equity release. It's been their ability to downsize, release cash, and that was as a function of the tax efficient environment. Just as we are seeing today, it's harder to have home ownership for the next generation than it was for my generation, my parents' generation. So as that becomes increasingly harder, it makes it more important to be focusing on retirement savings which aren't connected to a property.
New Zealand's total net wealth was $2.3 trillion at the end of last year. It grew in the years 2020 and 2021, alongside asset prices and stimulus payments, but has been declining for the past 2 years as inflation impacts the economy and results in higher interest rates. That's benefited those typically aged above 55 years, who hold more assets. They're estimated to hold 60% of total wealth, $1.4 trillion worth, according to economics research firm Bluck. Looking at the distribution of wealth, Statistics New Zealand survey says the top 10% of households held half of all total household net worth. That inequality is expected to continue to exist if the great wealth transfer from baby boomers to their dependents comes to pass. Malcolm, how are you thinking about the wealth inequality in this country and the potential implications that can have on our economy and also our society?
I think it doesn't matter which end of the wealth continuum you're at, it's always about financial security. Whether you're of a high net worth or somebody whose KiwiSaver balance is at $30,000. Financial security is paramount in both situations. The outcomes are different. If they lose that financial security, will be influenced different at different ends. But I do think the financial security still is the core issue which people grapple with regardless of how much or how little they have. There is a different group of, I think, an increasing barbell in New Zealand. I think I was out of the country for nearly 20 years, and in that time it became apparent when you came back that this barbell had really, really stretched, and that is where getting involved in the KiwiSaver process has been something which I've been very focused on getting into, because I do think that does help change the magnitude of that barbell in terms of lifestyle outcomes or life outcomes when you hit retirement. We can't change the whole system, but we can at least try and make a difference when they get into retirement.
Matt, have you got any thoughts to add there?
Yeah, look, I think the large chunk of that 2.3 trillion is the houses, right? Residential is comprised of the exposure to residential property. And therein lies a big risk, and that's always been a little bit of angst about our sort of national private balance sheet, if you like, the overexposure to domestic property, driven by the tax advantages that you talked about, as well as the fact that it's easy to leverage, right? It's much harder to go and borrow some money to invest in a portfolio of shares. It's very easy to do it if you want to buy a house. So part of the conversation has to also be about what is the risk inherent in that balance sheet, because we as a country need to change. We keep talking about we need to change the residential property market. What people don't go on to say is, well, what that means is actually you need the relative price to income to change. So you need price to go down, or you need incomes to go up. People don't like to talk about that first one. We all like to talk about the second one. But actually what you do need is a bit of a repricing of those assets. If you have that, then suddenly you have quite a different construction of that portfolio. But at least part of the conversation here has to be the qualitative one about the risk profile of that, and the importance of diversifying that broader portfolio for people away, because otherwise, wherever you are, as Malcolm says, wherever you are on it, if your exposure, if the vast majority of your exposure is to your residential property asset, you're taking a really significant risk versus what a traditional portfolio might look like for an institutional investor like the super fund, for example.
Is wealth inequality inevitable in a capitalist society, though?
I think it's an outcome of capitalism as a system. Yeah, it is an outcome, but it's a choice also that we make from a political perspective, because we choose to make we choose as a nation the setting through the government, the settings that we want, and those things are how do we pay for the things that we as a country need, health, education, retirement income for retirees, and how do we pay for those? Pay for those with taxes, and what are the other sources of taxes? I think there's a lot of conversation about the outlier that New Zealand is around how do we tax some of these different assets, and I think that remains part of the conversation as well. We always dance away from that one too, right? We're one of the few, I think, perhaps one of the only countries in the OECD that doesn't have a capital gains tax in some form, right? We think that might be related to overexposure to residential properties? Probably.
Well, this is the reason I ask, because I wonder how you perhaps see this playing out politically. Could there be such a point that we get to where wealth concentration grows to a point where there does become appetite for the likes of an inheritance tax, which would impact the funds flowing to a firm like this?
Well, look, wealth concentration creates social instability, and so it's in nobody's interest to create social instability. The damage that creates is enormous. I haven't thought about the impact of something like that on this business. I guess the way I think about that is there's a really important conversation to have about how do we improve those outcomes. Yes, you've got some other settings over here in the political sphere, they may impact it, but the job of FirstCape is to improve the outcomes for those who are investing today and investing tomorrow.
A wealth tax doesn't address the overconcentration or overexposure to the property market by the average New Zealander. That doesn't address that issue at all. A wealth tax, as you'll see when it's applied across other geographies, actually ends up collecting very little. What you then have is a net outflow of money from New Zealand, from the people who are here investing into New Zealand. So I think it's a politically easy one, because it's a very populist one, to say, hey, we'll put a wealth tax on. As Matt was saying, we have this over-concentration to real estate as a function of an absence of a capital gains tax. That's also politically, that is the opposite of a wealth tax from a political perspective. That's really hard to implement. But there are settings on that continuum where, if you think about different versions of where capital gains tax can be applied, as you look at the UK, it's applied not to your primary residence, but it's applied to secondary and rentals, and so there are other areas where capital gains tax could be applied.
To your first point, the Laffer curve. is effectively what you're referring to there, is it? Where if you just tax people more, you'll actually earn less tax revenue.
Correct.
Let's talk about the intergenerational aspect of this. It's dubbed the Great Wealth Transfer. Apparently boomers in this country aged between 60 and 78 have $1.4 trillion of that net $2.3 trillion. It's assumed and estimated they'll pass on about 80% of that. Mum and Dad, please, that would be lovely. How are you thinking about both the opportunities and challenges that that transfer will create for FirstCape?
Well, within the JB Ware business and the Jarden Wealth business today, a lot of the conversations they're having with their clients who do fall into that cohort you just described affectionately as the boomers. That is a very central part of that conversation is how to protect that intergenerational wealth and how to transfer that in a way where it hopefully outlasts their children as well. So that will continue to be an opportunity and a conversation we will have with our clients. It is also, though, it's not just for the people who are at the high net worth end of the spectrum in that cohort which you described with, did you say 1.8 trillion of the 2.4?
1.4, an estimated for the above 55.
Yeah, so within that 1.4 though, that is still very much the average New Zealander homeowner. Still makes up the vast weighting of that 1.4 trillion just by number. And so it's a conversation they're also need to be engaged with. But that's again very closely linked to retirement savings conversations. Because before they get to transfer that wealth, they need to go through retirement. So the cohort you're talking about, that 1.4 trillion, will be diminishing as they are consuming that as part of their third pillar. So that is the big difference between that generation and the next generation. They're consuming that 1.4 to have the quality of life they expect through retirement.
Does that mean then that this great wealth transfer, so it's called, is a myth because it's all going to be eaten away, inheritance are going to be eaten away by inflation?
Consumption by the generation which holds it will take more out of it than I think people think.
This is it's often these things are described as there's some huge wall of something out there. You know, for the last few years we've had wall of maturities and everyone's like, oh my God, this giant wave is going to break. These things tend to have a sort of a slower process than some giant cliff or some wall or some whatever.
I should have included that this wealth transfer is expected to occur over a 20-year period.
Yeah,
so
that's
you're
right. So these things tend to happen sort of more slowly than perhaps the sensational headline might suggest. And I think, but what it does do is talk to the investment horizon of some of those investors. So to the extent that that is going to be transferred, and you talk about 80% of it perhaps being passed on, you know, in Malcolm's mind, people are going to consume a bit more than 20%, and so they should. But that then speaks to how do you help them think about what the right investment settings are for an investment horizon which now includes the next generation, which is where the obvious conversations are with clients.
Yeah, absolutely. And talking about those next generations, I'm not going to say boomers, but rather the millennials and Gen Zs of this world, myself included, they have different investment demands. More of them are doing their own DIY active investing. They're looking to adopt AI in their everyday lives. They're buying Bitcoin. How is FirstCape preparing for the changing custodian?
Absolutely right. The needs of the next generation are very different, and their aspirations are very different as well. It's not all about home ownership. It does include a variety of different risk appetites. You mentioned Bitcoin as one, which it's not necessarily just limited to the millennials and the Gen Z. That seems to have had an intergenerational attraction, but there is a very much, because you have, with the millennials and the Gen Z, they have a very long investment horizon. So they are looking for, as they come into and engage, whether it's with their KiwiSaver, hopefully sooner rather than later, or with the JB Ware and Jarden Wealth side of the business, you know, their investment horizons and their risk appetites for that will be different to somebody, and their requirements will be very different to somebody who's much nearer retirement. And so, you know, that is then the purpose of FirstCape, is to try and be able to meet these diverse needs, and that is part of what we're doing today by bringing together the BNZ KiwiSaver business with Harbour, is capturing 250,000 New Zealanders, of which a big cohort are millennials and Gen Z.
Are you buying Bitcoin for clients? You mentioned there was intergenerational attraction. Are they asking you to?
No.
No, they're not asking, or no, you're not buying it for them?
No, I'm not buying it.
But are they asking?
Some clients do ask about it. It's everybody has a. It's not a product I have deep knowledge in. So, it's not a product I have deep knowledge in to a level where we would be advising people to invest into it.
Could AI advisors be a thing of the soon future?
Well, AI and robo-advice already exist today. It's already out there. And you're seeing it across the Tasman, you're seeing it in the US, and it's often an automated, guided conversation. So you will continue to see AI and technology playing a bigger part in all elements, whether it's in wealth advice or in asset management.
Last question for you, Matt. Sustainable finance. You're big on this.
Yeah.
You align the super fund to meet global climate targets. You saw it make ethical exclusions from its portfolio. You said last year at the Responsible Investment Association conference, which was actually when I interviewed you for this show last, that was a good time. You said, there's not much point in building up a store of wealth for future generations if in doing so, we create an unlivable environment for them. What are your plans to influence this in the private investment space?
In the FirstCape space, So look, I firmly believe that we can't as a world use natural capital to produce financial capital, which is what we're doing, when future generations are going to need both of those things, right? So we've got to do our investment in a way that preserves and protects and restores natural capital. That for me, as I look at the different parts of FirstCape, they're already doing this. So BNZ has a very strong sustainable investment approach. It's already undertaking exclusions and screening, and as well as incorporation and integration of ESG factors, as is Harbour, as are the advisory teams in both JB Ware and Jarden. So for me, I think there'll be a conversation in there, which is how do we make sure that those things are consistent? But I'm really encouraged that they're converted, they're already there, and for us, we just have to keep that conversation going with the broader investment industry, because it is really important. Where capital goes, affects those outcomes, and so thinking, this was the point I was making at that Responsible Investment Conference last year, thinking about sustainable finance is not just saying what is the impact of these things on our portfolio, it's what is the impact of our portfolio on these global trends, and that's where best practice is, and so that's where we have to continue to go.
Well, you both have very big jobs ahead of you. I'm just going to triple check, at what point can we celebrate and do this again, MJ, when the private savings capital pool hits what figure? Total value?
Within FirstCape or within the economy?
Within the economy, and then FirstCape's share of that too.
I do think we can celebrate when we get to where Australia is today.
I look forward to that day. Thank you both so much for your time and for having me in. Great to be back.
Madison.
Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below, and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.